Next, we move into bankruptcy. Now, bankruptcy has a very bad connotation in terms of what it means, and also some misnomers. So let's just start with the bad connotations. The U.S. government needs to have laws to make it so that when there's trouble, there's a way to protect those that should be protected. So bankruptcy is put in place not to protect the owners of the current business, but to protect the interests of the other parties, the government, your employees, your creditors. So it's there really to essentially call a timeout and have a way to figure out what's best for those that you owe money to, and not you, right, as the owner. So Chapter 11 is one where, put it very simply, your company is worth more alive than dead. Therefore, all your creditors and the bankruptcy court find a way to restructure your business so you have a chance to stay alive and not die. So that's a reorganization. Chapter 11, reorganizations. Next is Chapter 7. Chapter 7 is where you look at it, you can't. So again, hate to put in these terms, but you're worth more dead than alive. So the process then is hastened. The death of your company is hastened. And there we say, how can we orderly liquidate this, get most as we can out of the business, and then use that money to pay the people that are owed money. And that's the orderly liquidation, or Chapter 7. So when we look at the bankruptcy laws, first is, what is bankruptcy timing? It's when you file yourself voluntarily, or when someone else forces you into bankruptcy by way of presenting to the court a bunch of claims that you've not paid and are way past due. And that's all it takes. Either you do it voluntarily or creditors force you into bankruptcy, because again, they want the judge to step in and protect their interests, because in their view, you're not protecting their interests. So voluntary, you see that you need help, you call a timeout, you give it to the bankruptcy court because they can do things you cannot. Next is involuntary, when we have a number, say 3 or 4 creditors, it doesn't take many, and they come together to the courts and they force you into bankruptcy. So the process by which reorganization occurs, kind of the worth more alive than dead scenario, is you file with the court and then you try to find a way to restructure your business. And that revolves around everything we looked at. There could be asset restructuring, or kind of running the business, revenue and cost restructuring, or restructuring of your obligations. Those obligations could include your debts to banks or others. It could include your leases to landlords or others as well. So any money owed. So then the bankruptcy judge would accept or reject that petition. And if they accept it, there's a time frame to make all this happen. The company will be given 120 days, not a lot of time, that's 4 months, in order to submit the plan, and another 60 days after to get that to get approval from the people that you're seeking to restructure. Again, it's painful. Part of the reorganization plan is the bank will cut half of the amount they owed and get a little bit of equity, or the landlords would change the amount of rent due, or the leases would be voided altogether by the bankruptcy court. The judge has the power to invalidate future lease payments and cut off a lease. Next, the creditors and stockholders get into voting classes, because it'll shift around, because companies who used to be creditors may shift in nature to now be an owner. And then the plan is implemented and we kind of swap out securities and ownership shares, and then now we have a new entity. This is a very tedious and painful process, but it's happened successfully many times in the United States. A lot of these are private, you never see, but the big ones that you've seen are companies you know. Macy's went through bankruptcy and came back out and survived. Chrysler went into bankruptcy, came out clean. They got in trouble again, but they did survive. And the most famous example in recent years is General Motors. Had a very visible bankruptcy proceeding, and the federal government came in to bail out GM. And the people that were owed money prior, let's call it the old GM, were changed in their characteristic to now become owners of GM. So these are examples of what happens in a reorganization or a Chapter 11. So what might it look like when it comes out the other side from the court? One is cram down. This is where we just change people's amounts owed to make it possible for the company to survive. Second is DIP, debtor in possession. This is where the bankruptcy filings and the period has begun, and yet we need money. Let's say you're Macy's and you have no inventory. Well, you're definitely going to die as a retailer if you have no inventory. So the court may allow new money to come in, lend it to Macy's, but as debtor in possession. What that means is whatever monies is owed to you is priority above the old claims. And this allows vendors to still sell to Macy's even though they may be in bankruptcy protection and not feel they're being foolish. They're going to lend it, but they know that they're ahead of the line from the other older creditors, and Macy's will be probably in financially okay shape to pay these DIP loans, even though some of the other ones may be not paid. The DIP loans are far safer than the general unsecured creditors. And the other is a prepackaged bankruptcy, where you kind of have the plan all together and then you bring it to the court and the plan is proposed and we file it, and it happens pretty amicably. So this happens occasionally, and in these cases the company's done quite a bit of work to anticipate the results of bankruptcy, and they're doing it without the pressure of the timing and the judges, to see if they could work among all the creditors a plan that everyone will find acceptable. So Chapter 7, this is where we're liquidating in an orderly way. Here's where the hierarchy is everything, because you're getting in line for money and you know the money's going to run out. So everyone is fighting to be at the front of the line. I mean, again, very graphic, but relatively accurate depiction of how it goes. They scramble. First is any administrative costs for liquidation, court costs, things like that, to get you through the process. Second is to pay the employees that were owed money, and any unpaid benefits such as pension or medical claims are paid. Third are specific consumer claims that may have taken precedent by judgment of the judge. These are returned items, things of that sort. Next would be tax claims. The Internal Revenue Service or property tax are examples. Next come now the creditors. So notice we've gone 1, 2, 3, 4, and outside creditors have yet to really see much money. So next would be secured creditors, where they have secured the inventory or secured a headquarters building or secured other assets, intangible portfolios, so they get taken care of. Then the unfunded pension plan, that's the employees, they worked hard, they should have the pension plan cover them, even if the company does not survive. And then we have general unsecured creditor claims. Everyone else that's owed money just gets in a one big group, and they're unsecured creditors. Then we get into equity. Preferences go to preferred stock, then to common. Last in line, common shareholders. Now, common shareholders have residual rights, and if it does well, they make all the money, right? We've seen that. Bankers make a little money, owners make a lot of money. But in bankruptcy, it's the opposite. You would wish you were a banker because you get money first, and if you're the shareholder, you might get zero. A reorganization might look like this. On the left is the balance sheet prior to reorg, and we see the cash is 10, down to $1 million of assets. In this case, the balance sheet side or the asset side does not change. But look at the liabilities and equity. The AP drops because we're going to recast some of those liabilities. Notes payable drop because some of those would also be recast to other classifications. Accrued liabilities are the same. Those are the wages we're not going to touch. Then we have the mortgage. We're going to leave that. That's a secured lending. We're going to leave that in play because their position is quite strong. Then we have subordinated loans. So these are risky. So it went from 300 to 60. So what might happen kind of behind the scenes is the common stock goes from 100 to 60, but what might have happened to get to the 60,000 is some of the people that were taking lesser liability positions, such as the subordinated loans or the notes payable to the bank or to some of the general creditors, they now may become shareholders of the company. So they may forego their debts as getting repaid. They may still have stock. So if and when the company does well, they will get some of their money back because their stock would be worth something. So this is an example of reorganization and how the liability section and equity section could be recast in order to enable the company to survive. The company in this case went from a negative equity position on the left of 100 minus 400 or 300,000 underwater or insolvent to now where there's a very thin amount of 60,000, but at least it's positive. So this is an example of a reorganization. So summarizing Chapter 16, we looked at financial distress. So watch for the early signs. We know what it looks like when it's in deep trouble, but that's why we do ratio analysis and trend, is to try to anticipate problems and do something about it. Insolvency is where you can't meet your obligations. It could be on an actual basis where you have a balance sheet that's upside down, or it could simply be that you are unable to pay your obligations as they become due. And this is the one we call cash flow insolvency. We could do turnaround. We could turn around the operations, the financial or the asset side of the business, and then take care of putting the company back in a positive income statement or cash flow position. Fourth is reorganization, liquidation. We want to keep it out of the courts, so we're working diligently with all our creditors and our business partners to try to find a way to keep in business. Next is we've given up in a way and we need the help of the courts, and we go to Chapter 11, which is to reorganize so that we change the balance sheets, but we're at least still in business. The final last straw is Chapter 7, where we're worth more dead than alive. So then let's give up and let's just sell the assets and give money as much as possible to those based on the order of payment and call it a day. All right, so we now have gone through every step in the stairway to heaven. We've hit the top of the stairway. Some stayed at the top and went IPO or M&A. Some fell from the top of the staircase in the case of a bankruptcy. But we've reached the end of the story for a high growth venture, hopefully in a positive fashion and harvest, but perhaps in a troubled, hopefully not a horrible ending. All right, we're done with the lectures. So we've covered all 10 of our lectures at this point. The only thing left is the workshop and the final exam. Thank you, and I will see you in on class.